Wouldn't you like to keep your money in your pocket and minimize your tax burden? Many Canadians don't give it much thought until April rolls around. By that time, it's too late. You want to have tax opportunities, you have to take a step-by-step approach throughout the year leading up to April deadline. That'll save you the most money and time. Tax planning is perfectly legal and legitimate. As a matter of fact, the Supreme Court of Canada said that you are entitled to arrange your affairs accordingly to minimize your taxes. We'll set some of the most common rules and tax planning techniques that are currently available to individuals and that are often overlooked. Here are some general techniques to use in order to minimize your tax expense at the end of every year. The first one is RSP, which people look at and they say, well, it's pretty basic, and they don't do it because eventually when you take out the money, you're going to be taxed on it. Well, how would you like to get return on investment of 35% when you put money in the very next day? That's what an RSP allows you to do. A contribution to an RSP will allow you to put the money in today, and if you make over $50,000, get a 30% return on that money. In other words, if I put in $10,000, I get $3,000 back from the government within 2 weeks. So the contribution room right now is basically on your notice of assessment. So every year you get the notice of assessment in April. Look at it and you'll see how much contribution room you have. The maximum limit for this year is $23,820, and that means if you have an earned income of $132,333, then you get the maximum deduction. RSP is based on income earned, not necessarily income, because there's such things as interest income, dividend income. They do not apply for your RSP limit. Unused deductions are carried forward and can be used at any time. So if you have $23,000 that you can contribute and you contribute only 10, that $13,000 gets accumulated in the next year, and so on and so forth. So an RSP is a very good component for an individual to improve his tax position and should be utilized on an annual basis. And also there's another factor, that any income earned within the RSP is earned tax-free. So in other words, if I make $10,000 in interest in my RSP, I pay zero. If I earn $10,000 personally from a bank account, I pay $3,000 to the government. So therefore, that's why it's important that you utilize your RSP, not only for the immediate tax savings, but future tax savings on the income earned inside of it. Another component of RSP is the RSP Home Buyer Plan. So if I'm buying my first home, I can utilize up to $25,000 in interest-free financing by putting money into an RSP, getting the refund, and then taking it out and buying a home. There are certain criteria that you have to look at. The home has to be purchased within 12 months of you taking the money out. This is very important if you're going to be closing the house 2-3 years down the road, which many people forget when they take the money out. You have to pay the money back within 15 years, starting 2 years after you withdraw it. So what would happen is basically you take the money out, you take $25,000, you divide that by 15, and 2 years later you start paying it back a little at a time. If it's not paid back, what the government does, it includes this in your income for that year and you will pay taxes on it. There's another component to RSP which is very important, and that is setting up a spousal RSP. A spousal RSP allows you to put in money into a spouse's income and allows you to take it out, but the income would go to the spouse, not necessarily to you. So let's get to a thing called income splitting, where you split income between a husband and a wife. Firstly, we'll talk about an investment. When somebody makes an investment and wants the income to go to the wife rather than the husband, there's methodologies that have to be used to be able to do this. If you just give $100,000 to your wife and she goes and invests it, that income that's earned on it would automatically attribute back to you. If, on the other hand, you give your wife a loan and she has to pay 1% interest on that loan, any income earned on that $100,000 is now income to her. And now what you've done is split your income between yourself and your wife. Now we're going to talk about income splitting for pension. What's happened recently is that if you have a pension, you're allowed to make a joint election and therefore split the income between yourself and your spouse. For example, if one spouse makes $150,000 and the other spouse is retired and makes zero, you can split the income between the two parties and therefore lower your income to a much, much lower tax bracket. Tax-free savings account. This is a new animal that just came out and allowed you to put in $5,000 a year from 2009 to 2012. And as of 2013, it was increased to $5,500. So right now you can put up to, if you haven't put anything into it, $25,500 into this account and earn income tax-free. Wouldn't it be great if you had a hot tip on a stock? You buy the stock in this account, you spend $25,000, stock goes from $25,000 to $100,000, you make $75,000 tax-free. This is a great vehicle for small investors to earn income without paying any taxes. But please be aware, you should not go over the $25,500 because there's harsh penalties if you do. The next thing we're going to talk about is RSPs for disability. If you have a child who is disabled, please be aware that there is a registered disabled savings plan for him, and you should talk to your accountant about this because the plan is there to allow savings for a disabled person and you get disability tax credit. So it's a great vehicle to save for somebody who has a handicap. A registered education savings plan allows you to save for future post-secondary education such as college and university. It allows you to put money away on an annual basis and then you can put that money into an RESP. It earns income tax-free, and once you take the money, the income is taxed in the hands of the child, not in the hands of the contributor, in other words, the parent. And this allows you to split income down the road. The maximum lifetime exemption is $50,000 on the RSP. Another thing that is a unique animal that very few people use and should be used by small business owner is an independent pension plan. And allows you to contribute in excess of your RSP into a pension plan for future income. So say you want to earn $100,000 when you retire, it allows, and you've been earning $150,000 to $200,000 in your job, it allows you to put money away into an independent pension plan for yourself and your employees, and you could contribute you can contribute up to $10 million, $20 million into this, and it's deductible in the year that it is contributed in, and only gets taxed in the hands of the individual who got the pension when he receives it. So it's a great vehicle to generate an expense in a year when you've had very good earnings, and it allows you to save for your retirement for the higher income earning individuals. In other words, if you want to have income in excess of your RSP, it's a great way to do it. Go to your accountant, ask them about the independent pension plan. You need to work in conjunction with the insurance industry and actuaries. So that's something that I think every owner of a business should be looking at. Family trust. Family trust is a unique animal that allows you to transfer assets to the next generation. It basically starts with a settlor who settles the trust, and then he's out of the picture, a trustee who runs the trust, and a beneficiary who is the person who eventually will get the money from the trust. The trustee and the beneficiaries can be the same people. So under the trust, it allows you to put and transfer assets to the next generation, but it also allows you to do other things, such as income split along the way. So in other words, if you have beneficiaries who are your kids, and you have 3 kids, and they're all over 18, I'm allowed to give them a dividend or a salary from a company that we own. And therefore, it allows the parent to control how much money is given and who it's given to. In other words, if a child is getting married, he can contribute more, give more money to that child rather than to the other children. So it allows for a lot of flexibility. Also, the other thing that a trust allows you to do, which is very important, it allows you to protect your assets for family law, and it allows you to protect your assets from creditors, which I think in today's world is very important. The next thing we're going to talk about is the lifetime exemption on capital gains. If you own a small business, you get a lifetime exemption of $750,000, which is realized on the disposal of a small business corporation. So if you sell your business, you can get a $750,000 in your pocket tax-free. It's very important that you look at this. Now, another component of this, which is very important, is that a building that is used in an operation is deemed to be a small business company, and therefore, when that building is sold, you could get this $750,000 capital gains exemption. Many companies do not take advantage of this. So know that you have the exemption and take advantage of it. Asset protection, we talked about the family trust, we talked about the asset protection. Next we want to talk about is the different types of income, because it's very important that you know the different types of income. What is dividend income? What is salary income? You should calculate your salary to dividend mix on an annual basis. You should have an accountant look at it, because the tax rate between salary and dividends are different. And you want to make sure that you have the optimal mix. And this is determined often by the cash flows that you have, your income needs, and just such other factors such as payroll taxes and other things like that. Because it's not just the salary, it's how much WSIB do you pay, how much CPP do you pay, how much EHT do you pay, how much EDT do you pay, employee deductions tax do you pay. All these components add up and should be factored in by your accountant when he's determining the mix. Also, there is the determination based on how much RSP, as we talked about. RSP allows you to get maybe a 30, 35, even up to a 46% return on your money very quickly. And under these circumstances, you may want to get some earned income, some salary, so that you can take advantage of the RSP. Okay, so these mixes are very important. What should I do? Let's talk about, there's different tax brackets and rates. The top marginal tax rate is 48% right now in Ontario. So it's very important that you do things to minimize this, because if you do not, you'll be paying 50% of your taxes to our friends in Ottawa. And this is something you do not want to do. So going back and reiterating what we talked about before, put your hands in your pocket and keep your money there. Do not have somebody else have their hand in your pocket and take it away. So consult with a professional. Ask your professional to go over all these points that we discussed previously and evaluate your situation. Because the one thing that is key is that every situation is different, and therefore you've got to plan the year before, if not more, to ensure that you minimize your taxes over an extended period of time.